Hello, entrepreneurs. Good evening. Happy November 3rd, Tuesday, election day. I don't even know what the results are yet. I haven't checked. But welcome. My name is Joe DiChiara, and tonight I present How to Win at Business, brought to you by bedrockuniversity.com. There is no COVID-19 at Bedrock. Classes are open and fully staffed with world-class professors. Visit bedrockuniversity.com today. And Sudoku, handmade crafts, COVID-19 masks, Christmas stuff, all handmade with love by my mom and my sister Sid. And my mom's name is Cookie, and that's where they came up with Sudoku. I had nothing to do with that. But visit Sudoku.com and bedrockuniversity.com for unbelievable deals. And tonight, if you don't know me, let me introduce myself. My name is Joe DiChiara. I am a CPA Entrepreneuraholic. I love talking about business, how to succeed, why businesses fail, how to avoid failure. Actually, not how to avoid failure, but how you got to know what causes business failure. And that gives you information on like what not to do. So I like talking about that. I like teaching it. I have mastermind groups. I do, but my business is really just basic bookkeeping, tax preparation for very, very small businesses, especially new business owners. So that's what I do. I've been doing it for a long, long time. I'm a CPA over 37 years. I think it was 37, whatever. In 1988, I became a CPA, and I've done a lot of different things in the field, including, major audits, all kinds of tax audits, sales tax, payroll, income tax, criminal investigations. Basically got a feel for what triggers the audits, what people can do to avoid them. And I had somebody mention to me the other day, actually it was a couple of weeks ago, that audits are only a problem if they're not in compliance. Well, that came from somebody that never actually went through an audit, okay? Because audits are always a problem, always. Now, if you're doing something illegal, I mean, it might be a real problem, but you don't want to be audited. So, that's my story. I'm sticking with it. I have a different kind of background than most CPAs. Tax preparers, most of them have never handled a tax audit. Most of them are learning how the IRS works through reading instructions. They've never actually, dealt face-to-face with an IRS agent. They never had to appeal an opinion. They never had to, respond to a 30-day letter, a 90-day letter. They never had to file an appeal and make a claim in tax court. I've done all that stuff, and I'm not patting myself on the back, but it's become apparent that there's a lot of amateurs out there. So if you have never stepped inside an IRS audit office, you have no business talking to people about what triggers a tax audit. I'm sorry. If you've never created an entity and had to file tax returns, you have no business telling people if they should be an LLC or an S Corp or a sole proprietor. I'm sorry. You just don't get it. You don't see the ramifications of choosing the wrong entity. So, without further ado, let's get into tonight's training. Which I've been, itching to do. I'm going to cover the benefits of LLCs. I've been talking about how bad LLCs are, why you shouldn't be one, but there is a place for LLCs, and we're going to go through that quickly tonight. And, just so I stay consistent, I like to stick with my story, and I like to, I am a problem solver. And the first problem that I realized in business is that forget about business. Life is tough. We live in a complicated world. It's fast, a lot of instant information, and it's just, that's the way it is. It's tough. If you don't like it, get over it. It ain't going to get any easier. And what happens with us when we go into business is we make it even tougher. It is not easy to be in business. Okay, so right away we take a tough situation and we make it even tougher by going into business because we think it's going to be easy. And lo and behold, if you just started a business, you're like 6 months in, you might be looking like this guy. Like, what did I get myself into? Most businesses fail. Most new businesses go out of business. According to Forbes, it's 8 out of 10, which I think is very, very low. There's those numbers just don't add up. Just like the SBA says, 50% of businesses will fail in 5 years. If you do the numbers, people, we'd have like 100 million businesses by now. I mean, think about it, because you get 3 million new businesses every year. If 5 years later, 50% of the first year are going to be gone, we'd have 1.5 million more. And then in the 6th year, we should have 3 million. No, we still only have 30 million businesses. It's flat. And the government lies. They don't want you to know that it's flat. They want you to think that the economy is expanding. Okay, it ain't. It ain't. My friend John says that almost all businesses will fail given enough time. And I believe that that's more likely. Unless you're a corporation and somebody takes over your business, you're going to go out of business. Eventually, when you die, your business will die. And that's a dead business. That business is over. It's done. Okay? Now, that ain't necessarily a failure. So you gotta look at what are they counting exactly? What are they counting? I count somebody that goes into business and they never make a penny in revenue. That's a failure. Or how about you go into business and 5 years later, you're still below the poverty level? That's not a success. So even businesses that are still in business are struggling to survive, and they're on their way to failure. That's the bad news. The good news is the reason why they all fail, the reason why it's so tough is because it's complicated and they make it confusing. And when I say they, I mean the machine, the IRS, the government, the insurance companies, the banks. They don't make it easy for a new business owner. And a new business owner automatically is classified as a sole proprietor. And that is a big problem because sole proprietors, number one, don't get respect in the business community. That's just a fact. That is a fact. You go into a bank for a business loan as a sole proprietor, you're getting a personal loan, not a business loan. So banks don't look at sole proprietors really as businesses. They look at them as people. You're not really a business because we're giving you a personal loan. And that's a fact. My goal with all of my trainings is to try to help show you how to make business a little bit simpler, fun, and profitable, because I don't know about you, but I have a lot easier time making money when I'm enjoying myself and when I understand what the hell I'm doing. And when people don't understand, they're confused. And when you're confused, you either don't make a decision or you make a wrong decision. So let's go through, because we still got 25 million sole proprietors out there that need to at least look at the other choices. And for some strange reason, LLCs have become one of those choices for brand new businesses. And so as an accountant, as a tax person, there's only a couple of things that I'm really concerned with when it comes to serving my clients. Number one is protection. I need to protect them from themselves, from what they don't know, so that they don't get in trouble. So my job is to educate and inform new business owners and to keep their taxes as low as legally possible. Protection, tax minimization, that's my job. So let's go through the benefits, and then you'll see where the LLC stands in my professional world. Tax benefits, zero. Like I've said so many times, LLCs do not have any tax entity classification. The IRS does not recognize LLCs because LLCs were created at the state level for legal liability purposes. In 1977, in Wyoming, and if you want to check my facts, I might get the facts wrong, but overall, this is what happened. A group of wealthy investors got the state legislator to pass this limited liability company law. And what that meant was it gave them a legal shield against creditors in their investments. So they were investing in things like oil wells, passive investments. So what happens with these, when you have a wealthy investor and they invest, at the time, they had what they call, and they still have them, limited partnerships. Well, when you invest money in a limited partnership, let's say you invest $100,000, you can only write off $100,000. You can only write off the amount of your investment because your liability, it's the tax rules, okay? Limited partnerships, it's a tax rule where you can't deduct more than what you put in. When you can deduct more than what you put in, it's called a tax shelter. That's what real estate is. And that's what you get when you do oil drilling. And that's what you get when you do things like coal mines, because you get what they call accelerated depreciation deductions. Well, those wealthy individuals weren't getting those pass-through deductions. They would have to wait until those investments actually generated money, cash, profits. So they would have to wait, a lot, and so it just didn't make sense. They wanted the legal protection. You own an oil well, that thing explodes. I guess you don't want to get sued. So the state legislature passed this law, and I don't know what hoops they had to jump through with the IRS, but the IRS finally, in 1977, accepted the LLC. And what they did was they said, you can be formed at the state level as an LLC, but we don't have a tax return for you. So if you want to be an LLC and do business as a partnership, you can elect to be taxed as a partnership. If there's more than one member, and that's when they came up with the default classification. So if you were one member, you were automatically a sole proprietor, unless you were one member buying real estate. Real estate owners are not sole proprietors. Real estate owners are investors. So you could be a single owner investor in real estate and own an LLC. So let me show you this. LLC Benefits. It's for these types of passive activities like real estate. So if I bought a building, okay, in the past, my choices were to be unprotected legally, so that all I could do was buy enough insurance on that building so that if something bad happened, the insurance would cover it. Okay, well, that doesn't make wealthy people comfortable. You got a lot of money, you want to keep it. So in the 1990s, all these other states started accepting LLCs in their own states. And now, so every state has their own LLC rules. Okay. So in the scheme of things, LLCs haven't been around that long, not compared to corporations. So, if you ask, legal people that actually go into lawsuits and stuff, LLCs, I'm not a lawyer, but there's still a lot of law behind it that hasn't been argued. So, and there's no, but again, I am not a lawyer. Those are all legal reasons, which I don't cover. But if a client came to me and said, I want to buy real estate, I would recommend that they buy it through an LLC, because it's a passive activity. And that's what LLCs were created for. And so that's what they originally were created for. And then what happened was, because of the nature of LLCs, because it was more than one member, and usually it was for a group of wealthy partners. And what they figured out was, well, with a partnership, you could basically write whatever you want into the agreement. So with the corporation, you're a shareholder. You have a percentage of the ownership, and that's it. If you own 10% and there's a dividend declared, you get 10% of the dividend, written in stone. You're not that confined in an LLC that's classified as a partnership. So in an LLC operating agreement, you can say, listen, this guy has all the money, this guy has all the brains, he's going to put in all the money for 10% of the capital, he's going to put in all the brains for 90%. You can't really do that with a corporation. You'd have to have some kind of really fancy shareholder agreement. And that, again, that's not something I do. So, and I just had this situation with two clients that had corporations, and one of them wanted to own the other one. So they wanted to be 50-50 partners in one. Well, that creates problems. And what I told them, my advice was, they got to see a lawyer about the legal ramifications, because now you need a shareholder agreement. Another option for them is to actually be an LLC and then be taxed as an S corp. So that's another, you don't have those options as a corporation. You are more limited. The rules are more defined. Okay. And that's where they come up with, it's easier to run an LLC. Yeah, it's easier because you can make up the rules as you go, as you want. And a lot of states aren't going to require you to have like a board of directors meeting and the documentation that they say is so complicated. So in a partnership, LLCs might be appropriate. Another option that I recommend to people is, you just have a joint venture. In other words, you can have two corporations and they have an agreement to share revenue or whatever. You don't have to go opening an LLC for a whole nother level of complications. The idea is when you have a business that you want to do, what's the easiest, most effective way to create it? And if you want to go into business with somebody, it's going to involve a lawyer. So that's another benefit. Sophisticated business deals. Like I said, I have wealthy clients, friends, and they do deals with people in all different states and different percentages. And with an LLC, you could have the LLC own a corporation, and a corporation can own the LLC. So there's all kinds of, commingled situations that you can use an LLC for. You can use an LLC to just buy property and put it in there. I know people that open LLCs and buy yachts. And you if you're going to buy a yacht, you want to put it in an LLC. Okay, and there's a lot of good reasons for that. And actually, you want to do it offshore to save the sales tax. But that's just something I know by being in the yacht world with people. But you put a yacht. That's how they do it. They form an LLC, and then the LLC buys the yacht. So those are some of the reasons to use an LLC. But when somebody opens a new business and considers an LLC as an option, it shouldn't be. It just shouldn't be. Maybe for a tiny, tiny fraction. Maybe there's a business out there that it doesn't make sense to be a corporation for whatever reason, and they're exposed, legally, and then maybe that would fit in with being an LLC. Personally, I have never seen any kind of situation like that. Over 40 years in accounting, it has always been a simple mathematical equation. Okay. I have used 40,000 as the break-even point from 1988 until a few years ago, when technology made everything a lot cheaper. Okay. So if you had a sole proprietorship making more than 40,000, and I did the calculation 1,000 times, it made sense to be a corporation, even with the added cost of having an accountant. So in other words, if you're making less than that, well, you don't need an accountant. Well, if you have a business, you should have an accountant. So the accounting expense shouldn't even be an issue. If you're in California, there's an issue with the $800 gargantuan minimum tax fee. But $800 is a lot less than what you pay in self-employment tax as a sole proprietor. So it just doesn't make sense, people. People are choosing LLCs for the wrong reasons. For the wrong reasons. Tax people should not be practicing law. So when there's a legal issue, like I said, if you have shareholders, you got partners, you got some kind of sophisticated business deal, you need a lawyer, but not to choose what kind of entity you're going to be taxed as. That's not a legal question. It's a tax question. Your entity should be configured to maximize your tax benefits. LLCs do not do that. So when I posted this question in a large Facebook group with tax preparers, over half of them said that they should consult an attorney. Why? Why do you need to consult an attorney when you have two choices? Sole proprietor or corporation? You know, as a sole proprietor, you got problems, okay? The IRS is on you, you got legal issues. You don't have that with the S Corp. This is a no-brainer, folks. And the flack that I am getting, the pushback from the professional community is freaking amazing. It is amazing. And that, my friends, is where the real problem lies. Yet the government does not want people to become S Corps for the simple reason that it's going to drain Social Security even more. Okay, you take 25 million sole proprietors that are all paying Social Security taxes and you make them S Corps. What do you think that's going to do to Social Security that's already bankrupt? Think about that. Think about that. Does the government, does the IRS have any incentive to promote S Corps? They have zero incentive. And that's understandable. But at the next level, folks, when you get to the accountants, the attorneys, the insurance people, the financial planners that are telling their clients it's okay to be a sole proprietor and it's okay to be an LLC, you're wrong. You are wrong. And if you don't agree with me, let's put the numbers side by side, take all the emotion out of it, because it's a simple mathematical equation that does not involve any legal issues. It's not a legal issue. It's a tax issue as to whether you want to be an S Corp or a sole proprietor. And like I said, and I'll say it till the end of time, LLCs don't count for tax purposes. So that's my story. I'm sticking with it. If you don't like it, sorry, but I'm sticking with it. LLCs are not appropriate for operating entities. The simple single owner, sole proprietor does not belong as an LLC. Simple as that. If you are an LLC, you haven't done anything for your taxes. Okay, so God bless, over and out. I hope the election turns out right. Good night. I will see you tomorrow.